So once we have the prices, well, now we're ready to dig into what is more commonly used as our variable of interest, which is the asset return, the percentage change in that asset price from one period to the next. So if you invest $1,000, how much is that $1,000 going to rise or fall day by day or period by period? Okay. And we'll see that a lot of our models are going to be centered around this transformation. And for most of what we're going to be doing, we can just simply think of a return as that percentage change or the growth rate from one period to the next. And here we're ignoring splits and dividends, so we're assuming that that's all been baked into that adjusted close. So our new notation here, the R sub IT, that's the return paid on asset I at time t from period t minus 1 to t, so what you've earned today. And we could write that as the ratio of the current to the lag, so PIT versus PIT minus 1, which simplifies to what's probably easier to think of as just the change from yesterday, t minus 1, to today, relative to what the value was yesterday, or the difference over the lag of that price value. And note that this is the capital P, so this is without the log transformation. Okay. But oftentimes, this will be the first thing that you do. Once you've gathered your price data, the PIT, you'll go right to calculating these returns, and that'll be kind of our time series of interest. Okay. You'll also sometimes see this as the gross return, which is just the ratio here. So if you've earned 5% return, the gross return would be 1.05, right? So you multiply that by the initial investment. That'll tell you how much you have after that return has been calculated. That's used less often as a dependent variable. We could also calculate, instead of the 1 period return, a K period return. So if we have daily data, we might want to know what are we earning over a weekly period. So K equal to 5 trading days, or a monthly period, K equal to 28, something along those lines. And that would simply be the ratio of the price at time t to the price K periods in the past. And again, that's the gross return as opposed to the net percentage change. And since we had the price in log terms, turns out that can be real convenient for calculating returns as well. And here again, we'll use that notation. So the little r, that's going to be our log return, sometimes referred to as the continuously compounded return. So that's the natural log of the 1 plus RT, or the gross return, which can be calculated as the log of, again, that ratio of the price today versus the price yesterday. And you may recall that the natural log of a ratio is just the difference in the logs. So our little p, that's the log of our price at time t, minus little p t minus 1, the log of the lag, this difference will approximate our log return, right? So once you get your price, take the log, then calculate the difference. You don't have to do the dividing, right, to calculate the percentage change when it's in log form. That's going to be another way to calculate, another way to represent our return. It also makes it easy to calculate that K period return. Same idea. You just go back, instead of 1 period, you go back 5, 10, whatever the case may be. K periods, so that's going to represent the percentage growth from K periods in the past to today, and just the difference in the logs of the prices for exactly the same reason. Okay. We're skipping a little bit of math here, but when you see these calculations made, that's what it's trying to calculate. Okay. So let's get back into our data example to see what this is going to look like and how we're going to calculate it. The first thing I did, I just got tired of dealing with the the full name, the adjusted close underscore AAPL, and we're just going to call that P underscore AAPL. So we use the rename command in Stata, and that'll give us the simple return calculation as the price today minus the price yesterday. So that's the lag operator, that L dot, divided by the 1 period lag. You could also do this with the difference operator. But that's going to be the percentage change, and I've labeled it here SRET, the simple return on Apple, as opposed to the log return, which is just, okay, that's not right. That's supposed to be, sorry, minus. There we go. The log return is just going to be the difference in the log price. So log price today minus the lag of the log. I don't know how that equal sign snuck in there. Okay, but again, a simple calculation, and now we've created these two series that, in this case, the difference between them in terms of their behavior over time is going to be really small, right? Sometimes, depending on the frequency of your data, you can get fairly large differences between the continuously compounded or log return versus the simple percentage change return. With daily frequency, the differences are usually very small. So you can use either one. And again, for our purposes right now, either one is going to be perfectly fine. Okay. But you should also note that the random variability in these returns is definitely kind of dominating the behavior. It's going to be a lot more difficult to explain the behavior of these returns than it was to explain the price, which was, in the case of Apple, trending upwards, and past value had a lot of explanatory power over the future value. So we're going to set our expectations a little bit lower here, but this is going to form kind of our new dependent variable that we're going to try to explain these asset returns. So now that we've made the translation from price to return, we can think about what models are out there that can help us at least kind of organize our thoughts about how asset returns change over time and how they relate to one another. And the kind of baseline, foundational, classic asset pricing model, which somewhat counterintuitively relates to returns rather than prices, is the CAPM model, the capital asset pricing model that goes all the way back to 1964 and 1965. The initial model attributed to Sharp and Lintner. Various modifications and modernizations of the model have followed. Basically every year we get a new look at the CAPM model. But this is a great place to start and a great kind of baseline model to compare anything else that we do against. And we're going to do a very, very basic treatment here. The core essential idea that we're going to be extracting here is that the rate of return that's expected to be earned on a given asset, so when you buy an asset, what's the expectation of how that capital level is going to change one period to the next, is going to be related to its level of systematic risk that's going to be defined in a very particular way. And the idea being that the level of returns that you can expect to earn should be compensating you for the level of systematic risk that you are taking on by purchasing that asset. So what the model comes down to is defining a way to measure that idea of systematic risk. And once you have that measure, that's going to predict the level of returns. Okay? So when we talk about systematic versus unsystematic risk, again, being oversimplifying here, but the basic idea is unsystematic risk means that it's idiosyncratic, right? It's specific to the asset in question, as opposed to a general risk that the market as a whole is undergoing. And that's why we call it a diversifiable risk, right? So think of an example. If you're considering, investing in whatever, Pepsi-Cola, right? Well, what would be an idiosyncratic risk for Pepsi-Cola? Well, it's all the things that go into, predicting their profitability. So it might be, changes in the boardroom, unpredictable changes in who's the CEO or management style. Very, very specific to that company, as opposed to, well, what if we go into a recession, right? So those company firm specific risks, we would say, are diversifiable, right? Because if you bought Pepsi and you bought Coke, if Pepsi falters, well, Coke is probably going to be rising as a result of that. Obviously, silly example, but that's the idea, right? That firm-specific risks are very unpredictable, but they are diversifiable. The more firms you own, the more they're going to tend to counterbalance each other, as opposed to, again, systematic risk, which we think of as market-wide. Basically, if the economy goes into recession, both Coke and Pepsi are going to be hurting. Their profits are going to be going down, and their return on the stock is going to be going down as well. So we can think of this simply as the market risk, the shared risk, and that's why you have to be compensated for it, because you can't get rid of it, right? You shouldn't be compensated for diversifiable risk because you just have your portfolio structured such that when one firm goes down, it's going to be balanced out by another firm going up on average. So it shouldn't have an expectation of compensation. Okay. So now all we have to do is think about quantitatively, how do we measure market risk? Okay. So a lot of kind of theory, a lot of math goes into what we're doing here in kind of one slide, but this is enough for us. And especially whenever you see this phrase, it can be shown, right? Well, that means we're going to skip a lot of math, right? So it can be shown, we're just not going to show it. That for any portfolio or asset I, the expected future return will be a function of these components: the risk-free rate of return, the total market return, and, here's the key, the covariance between return on asset I or portfolio I and the market as a whole. This is going to be our measure of systematic risk, right? So as an equation, we'll say the expectation of our asset return will equal the risk-free rate of return plus this term here, right? So why would you be earning a return greater than the risk-free rate? Well, it must be because you're being compensated for systematic risk. So the systematic risk is going to be measured here. This beta, right, is going to represent how much you need to be compensated for what's happening in the market, right? So when the market rises, the expectation of the market return rises above the risk-free return. Well, you're going to be earning excess return on your asset based on what the value of that beta term is. And if we think of this as we will, as a regression, right? Well, this slope term relating market return to individual asset return, it's basically going to be estimated as our OLS beta hat, right? So it's the covariance between X and Y, market return, and our Y variable asset return, divided by the variance of X, sigma squared of the market. Right? And again, lots and lots that goes into this and comes out of it. But one way to think about it is, well, if your asset is not correlated at all with the market, if this covariance between RI and RM is 0, well, then it shouldn't matter how much volatility there is in the market. You're not going to be compensated for it. You're not carrying any systematic risk, because when the market goes up and down, your asset doesn't change if that covariance is 0. So that beta would be 0, and you would just be earning the risk-free rate. You wouldn't be earning anything above that because you don't need to be compensated, right? The stronger the correlation with the market, the more compensation you have for bearing that market risk. Okay? So, I know, there's a lot to unpack there. Basically what it comes down to is we can fairly easily turn this theoretical equation into a regression equation. All we really want to know is how closely does our stock track the market? And that's going to be what we'll call an approximation, a vast oversimplification, but an approximation of a CAPM regression. Okay. So one more thing on interpretation, that CAPM beta, again, what does it represent? It's our measure of systematic risk. So it's what ties together what the market does with what our individual asset does. Okay? And think about every asset out there has a different beta. And if you knew what that beta was, its correlation with the market, it would help you predict how that asset return is going to change. But in terms of interpretation, again, think about this, our systematic risk measure, that beta, representing the sensitivity of our assets' return to the market's overall return. And when you see a beta that's greater than 1, well, what that means is for every unit change in market volatility, asset volatility goes up by more. So we'd say it's an aggressive asset. A smaller value of beta, if it becomes less than 1, well, it's going to be, that asset is going to be less volatile than the market as a whole. So we can call that a defensive stock. And again, typically, an aggressive stock is going to have a higher expected return to induce you to hold it. A defensive stock is going to have an excess return a little bit lower, but you're carrying less risk with you. Okay, now here's the fun part. Let's put this together into a very, again, can't underline this enough times, simplified regression approach. So we'll call this the naive CAPM regression model. And anytime we make a simplification, we're making assumptions to make our life easier, right? So the first assumption is that when we talk about the market return, that we can proxy for that with an observable broad market index. So the default that you see used most often, not because it's perfect, but because it's easy, is the S&P 500 index. So it is a broad market index, but there are some shortfalls, primarily that it only represents publicly traded domestic stocks typically. And there's lots of assets out there that make up the market that aren't in the S&P. So right off the bat, this is not a perfect market return measure, but we'll get the level of the S&P, calculate the percentage change. That'll be our market return. Now we can capture the kind of the baseline risk-free rate. Typically, you'll see that with the U.S. 3-month T-bill yield or interest rate. These days, you can pretty much set that to 0 for simplicity. It is a nice feature if you go ahead and gather that data. But we can simplify it basically by kind of leaving out that risk-free rate, because honestly, it's about 0 over the last year. And we'll typically use daily frequency time series for all of our variables. So when we talk about returns, it's simply how does the value change one day to the next. Okay? And if we do that, the beta that we'll be estimating is simply going to be the slope coefficient from an OLS regression of asset return as a function of market return. So after all that, it just simply comes down to a y as a function of x equation, and the beta hat, the slope coefficient, is going to be the CAPM systematic risk estimate. So let's see what that's going to look like. Let's go back to our Apple stock, but this time I'm going to narrow things down a little bit. I am going to use the get symbols command again, and I'm going to get that Apple tickle, not a tickle symbol, that's a different thing, ticker symbol. And I'm also going to add the level of the S&P. So in the Yahoo Finance notation, it's the caret GSPC. So that's going to get what the S&P 500 does on every day since August 1st, 2019. So I'm roughly getting the last 1 year's worth of observations. So this is an option in the get symbols package. You can define where your data set begins and ends. So I put in a beginning, first year, 2019, FY, the first month, the 8th month, August, and the first day is the 1st of August. I didn't put an end date on there, so it just goes right to the most recent. Okay, and then again, the Yahoo is the option that we're using. So we're gathering it from Yahoo Finance. That all worked out pretty well. So usually a year's worth of data is about 250 observations. So we're about 20 days into August at this point. So that sounds about right. Then we'll do the kind of the usual adjustments here. We're going to create a time trend variable. We're going to tell Stata that that time trend T is our time, our way of denoting the passage of time. So that will allow us to use lag and difference operators. And then we'll jump right to calculating the return on Apple. So it's going to be the difference in that adjusted close over the lag of the adjusted close. And then do the same thing for the market. So R sub M, that's going to be the percentage change in the S&P. So the difference over the lag. Mission accomplished. So now we have what is going to be the Y variable of our CAPM versus the X variable as that market return. So we can go ahead and estimate the model. So we're just using the regress command in Stata. Asset return as a function of market return. And here is our beta hat. The estimated CAPM beta for Apple is pretty close to 1. So 1.097. It's highly significant. So that means it's definitely positive. And that's very useful information, right? So the beta hat is the slope coefficient, 1.097. So the fact that it's close to 1 means, right, when we had that beta greater than 1, we were aggressive, less than 1, we were defensive. So we're slightly aggressive, slightly more volatile than the market, but it tracks pretty closely. Right? And again, it's significantly positive, which is what our theory predicts, right? So a positive beta simply means the more market volatility there is, the more return you are going to earn. So, all that said, this is a great kind of foundational discussion. So in terms of what the typical variables are going to look like, asset prices, log asset prices, asset returns, simple returns, log returns, and then kind of the basic models would be something like a random walk model for prices or log prices, and a CAPM model for asset returns. And for the rest of our textbook, right, going down this path of discussing financial econometrics, no matter how sophisticated those models are going to become, it's going to be really, really useful to always refer back to these kind of basic foundational models to see, well, how are we doing? How much more are we explaining with this, highly sophisticated model that we'll get into later, versus what we could have done with a random walk or a CAPM equation. So always nice to have in the back of our minds. So that's basically what we've done here. We have taken a look at the building blocks that we'll be coming back to again and again and again when dealing with financial time series models. And looking ahead, if you have been assigned a data project, right, at the end of our semester, one thing you're going to have to do is decide, right, which assets you want to look into, calculate the returns, and again, no matter how sophisticated your models become, always compare them back to these very basic approaches. Okay, so this is going to be with us throughout the course, throughout our discussion. All right, so we'll take a look at adding trends and cycles and cyclicality on top of our asset price and asset return prediction models coming up in the next installment. So we will see you then. Thanks.